Hey everyone, welcome back to Corporate Decoder. Today QXO Incorporated is filing a material definitive agreement, and I'm seeing a potential game changer in the making. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company QXO is about to buy another company called TopBuild, and it looks like a pretty big deal. Alright, so what we have here is a filing, specifically a Form 8K, which companies use to announce big events that shareholders need to know about right away. QXO is reporting here that they have entered into a significant agreement, and this is all happening on the 18th of April 2026. The company we are focusing on today is QXO Incorporated. They are a Delaware corporation, and you can see their commission file number and IRS number listed here. They are essentially a publicly traded company that has to report important changes like this to the public. What is interesting is that QXO is in the building products business. Think about things like insulation, roofing, and other materials that go into constructing a home or a commercial building. They are looking to grow, and this filing details how they plan to do it by acquiring another company. This document officially announces that QXO has signed a merger agreement, which is a legal contract to buy another company. This is a big step, and it means they have likely been in negotiations for a while. QXO does have common stock listed on the New York Stock Exchange under the ticker QXO. They also have depositary shares, which are like units representing an interest in another type of stock, in this case, preferred stock. This tells us QXO is a publicly traded entity with shares that investors can buy and sell. Now, you see these checkboxes here. They indicate if this filing is also being used for other types of communications, like written communications related to a securities offering. In this case, they've checked the box for written communications pursuant to Rule 425 under the Securities Act. This suggests there might be some marketing or investor outreach happening alongside this merger announcement. This section is the heart of the filing. It is where QXO officially announces they've entered into a material definitive agreement, which is just a fancy legal term for a really important contract. In this case, it is the agreement and plan of merger dated the 18th of April 2026. So, who are they merging with? It is a company called TopBuild Corp, QXO, through two of its own subsidiaries, Titanium Merger Co. Inc. and Titanium Merger Co. 2 LLC is acquiring TopBuild. This means TopBuild will become part of QXO. Both companies are based in Delaware, which is common for large corporations. This is a really positive sign for the deal. When the board of directors of a company unanimously approves a merger, it usually means they believe it is in the best interest of their shareholders. The same goes for QXO's board, which has also approved the deal and recommended that their shareholders vote in favor of it. The agreement outlines a two-step merger process. First, one QXO subsidiary will merge with TopBuild, and then TopBuild. Now, a subsidiary of QXO will merge with another QXO subsidiary. The result is that TopBuild will become a wholly owned subsidiary of QXO. This is where it gets interesting for TopBuild shareholders. They are being offered a choice for how they want to be paid for their shares. They can either take $505 in cash for each share, or they can receive 20.200 shares of QXO's common stock. This is often referred to as a cash and stock deal, and it gives TopBuild shareholders some flexibility. However, there is a catch. Not everyone who wants cash will get it. The deal limits the amount of cash that will be paid out. Only 45% of TopBuild's outstanding shares can be converted into cash. The other 55% will be converted into QXO stock. This is a crucial detail because if more than 45% of TopBuild shareholders elect cash, there will be a proration process, meaning some shareholders who elected cash might end up receiving QXO stock instead. This is designed to balance the deal between cash and stock consideration. The merger agreement also details what happens to stock options and other equity awards held by TopBuild employees. These will be converted into QXO stock options or awards based on specific formulas outlined in the agreement. For example, stock options will be cancelled and converted into a right to receive QXO shares. Awards that are tied to vesting conditions will become fully vested. Restricted stock units and performance stock units will be converted into equivalent QXO equity awards, with performance conditions often being deemed met at a target level. For this deal to actually go through, several things need to happen. TopBuild's shareholders need to approve the merger agreement, and QXO shareholders need to approve the issuance of new QXO shares as part of the deal. The QXO shares that will be issued as stock consideration also need to be approved for listing on the New York Stock Exchange. Plus, they need to get regulatory approval, including under the Hart-Scott-Rodino Act or HSR Act, which is an antitrust law. Other conditions include ensuring there are no laws preventing the merger, the effectiveness of a registration statement for the new shares, and that the representations and warranties made by both companies are accurate. They even need an opinion of counsel that the deal will qualify as a tax-free reorganization under the US tax code. And importantly, there shouldn't be any material adverse effect on either company between now and the closing. The agreement also includes standard clauses. Both companies promise to run their businesses normally while the deal is pending. Crucially, neither company can go out and seek better offers from other potential buyers. This is called a no solicitation clause. Also, QXO has agreed to add one member from TopBuild's board to its own board, once the merger is complete. There are ways for the deal to fall apart if either company's shareholders don't approve the merger, or if a board changes its recommendation. The deal can be terminated. Either company can also walk away if the merger isn't completed by the 17th of January 2027, if the deal is terminated under certain circumstances such as a breach of the no solicitation clause or if the board changes its recommendation. The company that is terminating the deal might have to pay a hefty termination fee. In this case, that fee is a massive $600 million in cash. This is a significant penalty designed to make sure both parties are serious about going through with the deal. Beyond the merger agreement itself, the company is also filing related information. On the 19th of April 2026, QXO and TopBuild issued a joint press release officially announcing this merger agreement. This is usually the public relations push that accompanies such a significant corporate event. The day after that, the 20th of April 2026, QXO posted a recorded investor presentation. These presentations are typically used to explain the deal in more detail to investors, analysts, and the media, often highlighting the strategic benefits and financial projections. Now, how is QXO going to pay for this? They've secured a debt commitment letter. Dated the 18th of April 2026, QXO Building Products, a subsidiary, has lined up commitments from banks like Morgan Stanley, Wells Fargo, and Barclays. These banks have committed to providing a $3.0 billion senior secured term loan facility, and another $3.0 billion in bridge financing. This is a substantial amount of debt financing, which means QXO is leveraging debt to fund a significant portion of this acquisition. They plan to replace the bridge financing with more permanent debt before the merger is finalized. On the 18th of April 2026, TopBuild also entered into a voting agreement with Jacobs Private Equity II, LLC, identified as the supporting stockholder. This supporting stockholder, who owns a notable amount of QXO shares and preferred stock, has agreed to vote their shares in favor of the QXO share issuance and other actions needed to complete the merger. This is important because it helps ensure that QXO shareholders will indeed approve the deal, especially if there are many small shareholders whose votes might be unpredictable. The agreement also places restrictions on the transfer of securities held by this stockholder and will terminate under specific conditions, like the completion of the merger. Like most public companies, QXO includes a cautionary statement about forward-looking information. This is a standard legal disclaimer warning investors that projections and expectations about the future can be risky. They mention potential risks like the deal not closing, increased costs, or the expected benefits not being realized. It is a reminder that while this filing signals a significant event, the future is never certain. They also include a section on important information for investors. This part emphasizes that QXO will be filing a registration statement on Form S-4, which will include a prospectus and a joint proxy statement. This is the comprehensive document that will go out to both QXO and TopBuild shareholders, providing all the details needed for them to make informed decisions about voting on the merger. They urge investors to read these documents carefully when they become available because they will contain crucial information. This section identifies individuals who might be considered participants in the solicitation of votes for the merger. Essentially, it means that certain directors and executives of both QXO and TopBuild may be seen as actively encouraging shareholders to vote in favor of the deal. The filing points to previous proxy statements for details about their stock holdings and interests. Finally, we get to the exhibits. This lists all the documents attached to this 8K filing, including the merger agreement itself, the voting agreement, and the press releases. The most critical exhibit here is Exhibit 2.1, which is the full text of the agreement and plan of merger. While we've discussed the key points, the actual contract contains all the intricate details and legal protections for all parties involved. Here is the joint press release dated the 19th of April 2026, announcing the merger. This is the official public announcement of the deal. And the investor presentation from the 19th of April 2026, this would be the one where management likely walked through the rationale and expected benefits of combining QXO and TopBuild. The fact that QXO is acquiring TopBuild is a massive move. TopBuild is a significant player in the building products distribution industry. Acquiring them would dramatically increase QXO's scale and market presence. The deal structure, offering both cash and stock, is designed to be attractive to TopBuild shareholders. However, the proration mechanism for the cash portion is a key detail to watch. It means that if too many TopBuild shareholders opt for cash, some might be forced to take QXO stock, which could dilute the existing QXO shareholders or change the ownership percentages quicker than expected. The substantial debt financing, with $3 billion in term loans and $3 billion in bridge financing, indicates that QXO is taking on considerable leverage to fund this acquisition. This increases the financial risk for QXO if the integration of TopBuild doesn't go as smoothly as planned, or if the market conditions for building products deteriorate. QXO could face significant financial pressure due to this debt burden. A historical comparison might be useful here. When companies undertake large debt-funded acquisitions, especially in industries that can be cyclical like building products, there is always a risk. For instance, some large retail bankruptcies in recent years, like Bed Bath and Beyond, or even parts of Sears' history, involved aggressive expansion fueled by debt that ultimately proved unsustainable. While TopBuild is a healthy company, the sheer size of the debt QXO is taking on relative to TopBuild's business is a significant factor. For example, if we were to imagine a $1,000 investment in QXO before this news, and assuming the market reacts positively to the acquisition's strategic fit, but negatively to the debt load, you might see a short-term positive bump followed by a potential 5 to 10% drawdown over the next quarter, if concerns about integration or debt servicing arise. Looking at the risks highlighted in the cautionary statement, the biggest concern is the successful integration of TopBuild into QXO. If the company's cultures clash, or if the expected synergies and operational efficiencies don't materialize, the acquisition could become a drag on QXO's performance. The $600 million termination fee also underscores the commitment required from both sides and the potential costs. If the deal collapses, what I am really looking for next is how QXO addresses this significant debt load. The bridge financing needs to be replaced with permanent financing, and the terms of that permanent financing will be critical for QXO's financial health going forward. Oh, and the research tools I actually use are linked in the description. They help keep this channel going, that is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.